Hey guys, welcome back to the channel. In today's video, I'm going to be showing you guys how to optimize a pair trading strategy in case you want to trade a pair of your choosing, unlike my previous videos where I showed you how to find the best pair based off of multiple stocks within an index ETF. And instead with this script, you will pick the two stocks that you want to pair trade, and we're going to run it through an optimization to see if it's a good idea to trade the signals generated by the optimization. So what we're looking at is the equity curve based off of an optimization I ran between Tesla and the NASDAQ 100 ETF. Now, as you can see, based off of the optimization and the signals generated, had we traded this pair, it would have generated approximately $128 using one share lots. But what's nice about taking a look at the equity curve is that we see that the majority of the gains came from Tesla, and the Q's contribution to the gain was very minimal. So I wouldn't necessarily call this a good pair trading strategy. I would much rather see both of the stocks contributing to our equity curve and not depending on a single asset to generate returns. So I'm going to be showing you how to run this back test so that you can run it yourself. Now, the things that we're going to be optimizing for are three things. Since we're going to be basing off our signals off of percentile bands, which are the red and green lines here, we want to optimize and see which percentile to use along with the rolling period of these two bands. And lastly, the third thing that we want to optimize is the rolling period for recalculation on the spread, which is the blue line here. I will be going over the calculation, but essentially what we're doing is recalculating our spread every n number of periods. We're then going to calculate the upper and lower bands using percentiles off of a rolling period, and that's how we get these red and green lines. Now, the trading methodology is if the spread goes over the red line, we should go short until it crosses the green line, where we would reverse our position to the long side. So the black lines here are actually plotting our position. It will go positive when long and negative for short. And for the data, I'm actually using intraday data, and it's using 30-minute candles, but you could run this using daily, weekly, or any time period that you like. So let's go ahead and go over the code. So at the very top, I have required a couple of packages. We're also going to change some options for the high charts, and this is because I'm using intraday data and it kept using UTC time zones. So the way to change that is to run lines 12 through 14. We're also going to build a function to get the intraday data, which will come from the Trader API. But as I mentioned, you can use any time period that you like. Now in the second block, I'm going to assign the tickers that we want to use. So in my case, I'm going to be using Tesla and the Qs. I commented off this block because this is where I actually get the stock data. So make sure you uncomment this or add some code here to get the data for the two stocks you're assigning. And to save time, I save the data as an RDS file, which I'm rereading here in line 46. And the data should be in the data frame. So if we take a look at all stocks, we have our timestamp, our open, high, low, close, and volume, and then the symbol. Now we need to make a pair table based off of the symbols, as I did in my previous tutorials, which is the next block here. And if we take a look at combo stocks, this is what your data frame should look like. Now back in the code, I'm reusing the same function we used last time where we just pass in both of the symbols, the probability for the bands, which is passed in line 82 and 83, the rebalancing or rolling period to calculate the spread, which we will use in line 68, and the rolling number of periods for the actual bands, which is again line 82 and 83 here. So we're going to pass in both of our symbols, extract the data for each asset. We just need the close in this case, and since I'm using intraday data, I want to make sure that my timestamps are the same and are using the same time zone. We're going to combine the two, and then we're going to calculate our spread using estimate parameters historically from the pair trading package. We're going to extract our spread. We want to run our test to make sure that this spread is stationary, and we're going to be saving our results in a data frame. So by line 76, we're going to have both of our symbols along with the stationary test. Now by using the spread, we're going to go ahead and extract the percentiles for those upper and lower bands, which will get saved in down and up. And essentially what this function is doing is we're going to pass in our spread, and it's going to apply a function in a rolling period, which is the width, and I set by to 1 since we want to calculate this for each bar. And for the actual function, I'm just going to pass in quantile. It's going to grab a subset of our spread based off of the width from the spread, which will get passed into quantile, and it's going to extract the lower and upper bands by using the probability that we pass in. We also need to create a signal column, which for now is just going to be NA, and then we do our test on whether the spread is above the red line or up, which will return a -1, which means we want to go short. And when the spread is below our downline, we want to go long. We're going to use NALOCF to fill in the rest of the signals. So we're going to be continuously long or short until our signal reverts. Now we want to extract our results. And if you watched my previous tutorial on pair trading, I mentioned that I did not like the fact that we have to continuously adjust our positions based off of the hedge ratio. So instead, what I wanted to do was just buy the same number of shares for both of the stocks until our signal reversed and not use this hedge ratio, as as it would be costly to do so. But we're going to go ahead and extract the returns of both methods. So from lines 100 to 108, we're going to extract the total return, the average return, the maximum drawdown, and our ratio, which is what we're going to be optimizing for, which is the average return over our max drawdown for both the hedged and the non-hedged. And then finally, just return that data frame. Now we need to write an optimization function. So here in the next block, we're going to pass in the function that we just wrote. We're going to assign our two symbols, and we're going to optimize for these three parameters. And how this works is we're going to pass in a numeric vector containing three numbers, which will be used for the pair test. Now, if this did not generate an error, we're going to extract and optimize for the no hedge ratio. Since the optimization is seeking to minimize, we want to make sure we return the inverse of our no hedge ratio. So we want to make this ratio as big as it can. Otherwise, if there's some sort of error, we're going to assign our optimization value to 100. So in either case, it'll return that optimization value, which will get printed out in the console. Now for each parameter that we want to optimize for, we need to set the lower and upper limits. So for the probabilities, I'm going to set these between 1 and 15. For the recalculation of the spread, I'm going to be using a period of 9 and 200 bars. And for the rolling quantiles, I'm going to set these between 9 and 300 bars. We also need to make sure that we round these numbers appropriately, so we can't have fractional rolling periods. So the last two parameters are going to be integers, whereas my first parameter is going to be rounded to 2 decimal places. Now for the actual optimization, we're going to pass in our optimization function, our lower and upper limits, and for the number of iterations, you want to set this to anything higher than 100, but I've set it to 5 just so that I can show you what to expect. We also need to add our formatting function. So for each iterations up to your iter max, you'll receive a printout, which is going to print the optimization value and the value for each of the three parameters that it used. After the optimization run, we're going to pass in those optimized values into our pair test function to check out the results. So you'll see a second printout here. We see both of our symbols, and we also see that it returned true for both of these stationary tests, which is what we want to see. Now the next four values pertain to the hedge method. So if we were to use the hedge ratio and traded the pair using the optimized values, we would have seen a total return of 76%, the average return of the spread, our max drawdown, and then our ratio, which is the average return over our max drawdown. But since we were optimizing for our no hedge version, we want to focus on the last four. So here we see that the total return using the no hedge method was a little higher, along with the average return. We also see our max drawdown and our ratio. What I did was to extract all the contents within our pair trading function, and in line 153, I assigned the values to use. So it'll go ahead and extract the spread using the optimized values. And instead of returning our data frame, we're just going to plot the performance of each version for both of the strategies, which are fairly close. Now, as I showed you previously, we're going to plot the trading signals, and I'm going to be using high chart. So again, the trading methodology is that we're going to go short whenever our spread crosses this upper line, and we're going to remain short until the signal flips, which is around October 23rd. Lastly, we want to plot our equity curve. So I'm going to be adding our trade pricing of when we got signals. We're going to group the trades and add the cumulative sum to get our equity curve. So for trades, it should look something similar to this data frame. So it looks like we had a total of 17 trades. Now for the first two columns, I'm using the actual close price at that particular bar, and it's negative, meaning that we purchased it or it's a debit, and it's positive when it's a credit or if we're short. So based off of these two columns, we're going to extract the P&L for both of the stocks, the pair P&L, which should be the sum of these two columns, the cumulative sum of stock 1 and stock 2, and lastly the cumulative sum of our pair trading strategy. And all that's left to do is just plot it using high charts. So again, I wouldn't necessarily trade this pair because it looks like the majority of the gains came from one stock instead of both, but you can use the code to check whether the spread that you like to trade makes sense. But with that, guys, this concludes the video. I'll leave a link down in the description area to my Patreon where you can find the script. Please consider subscribing to the channel if you haven't done so already. Thank you so much for watching, and I'll see you guys in the next video.